Guys, we got some huge breaking news that we have to talk about here. The Fed is going to be putting restrictions on bank stocks after the tests that they did recently found that some banks could be stressed during the global issue. Bank stocks are something we've talked about on the channel before, and I also shared my thoughts on this sector, but it seems like things look worse than first expected. The banking sector has really lagged the broader market here during this recovery from the March 2020 bottom, and this is because of fears circulating around that these companies are struggling ever since we had lockdowns throughout the country, and bankruptcies and delinquencies are starting to rise. So now it's starting to make a bit more sense as to why this sector has lagged the broader market in this recovery, and it seems that investors were pricing in this bad news for quite a while here. And guys, on this channel I pride myself with always being transparent with my trades, whether I make money on them or lose money on them, and most of the time we talk about wins on the channel. But today I want to share with you something in regards to a bank stock. But guys, before I do, consider smashing that like button down below. Subscribe as well if you're brand new here, and turn on the bell notification so you get every alert as soon as I upload these videos. And I really want you to pay close attention here if you are invested in bank stocks or considering investing in these bank stocks, because I'm going to share some really important information today, and this could actually affect your investment thesis for these companies for the foreseeable future. Okay, so I purchased JPM stock back during the crash in March, but as things unfolded, as the months progressed, there were fundamental changes that happened not only with the industry but with this company specifically as well. This made me change my investment thesis around the stock and really made me more bearish on banking stocks in general. On June 3rd, I posted in my VIP membership group that I will be closing out my JP Morgan position, and I actually took a 5.36% loss on this position. But what's important here is that I shared with my members the reasons as to why I decided to close this position at a loss specifically, and why my initial thesis on this company had changed significantly because of events out of their control, but ones that would still eventually hurt them. I had changed from being very bullish on these stocks and this sector. JP Morgan is one of my favorite stocks that I always wanted to own. But with recent events, I've become more neutral or even bearish on this company specifically, and other banking companies as well, for the foreseeable future because of reasons that I'm going to be discussing in this video. Now, I'll be honest with you guys, I wasn't convinced initially when everything first started going down that these banks would get hurt this bad, but it seems to be a lot worse than first expected. Also, keep in mind this industry is ripe for disruption in my opinion, with players like Square entering the space. So that's just another layer of risk that you're taking on when investing in stocks like JP Morgan. Now I just want to throw this screenshot up here for all the haters out there. On the same day that I sold JP Morgan Chase, I also closed my position in Discover Financial, which more than made up for my losses in JP Morgan. Even though I had a position in Discover before the crash, I was able to average down quite heavily when it was near its bottom and come out with a 17% profit. And yes, these profits were much more than the losses that I incurred in JP Morgan, so I'm completely fine with that. But regardless, that's enough about what I personally have done. Now you know that I've closed my JP Morgan position. But what I want to get down to here is what has changed today that's going to affect these stocks for the foreseeable future. So a couple of key points were brought up from this Fed announcement. The first is that the Fed will be putting new restrictions on the US banking industry, which includes JP Morgan and other major banks. This is because it found that several banks could get uncomfortably close to minimum capital levels in scenarios tied to the global issue. So what happens, guys, is that the Fed does a stress test on the banks in the US on a regular basis, and this kind of helps them determine if the banks are in good standing. But this time around, when they did the test, the results from those tests concerned them. And it concerned them so much that what the Fed is going to be doing is requiring banks to suspend their share buyback programs and also cap the dividend payments of these banks at their current level for Q3. They also said that it would allow dividends to be paid based on a formula tied to banks' recent earnings. This puts a lot of pressure now on the banks, because if they do badly on their earnings, this will also directly affect their dividends because of this new formula that they have to follow. This is concerning as an investor. The two biggest value props for banks in general is stability and dividend income, and right now it seems like neither of these things are going well. Now, if it wasn't bad enough, the announcement also states that this industry will be subject to ongoing scrutiny. This means that for the first time in the decade-long history of the stress test, which was introduced back when the financial financial crisis hit in 08-09, banks will actually have to resubmit their payout plans once again later this year. So on June 29th, which is just a few days away from recording this video, the banks are expected to disclose their capital plans. When they disclose this, it'll pretty much determine whether they'll actually be able to maintain their current dividend payouts or if they're going to be forced to suspend that. So all eyes will be on this industry next week when these announcements come out. So this is a pretty big deal, guys. It's not something that you should overlook because it, yes, affects the banking industry directly, but banking stocks are a massive portion of the overall stock market. If these banks and financials continue to struggle, move sideways, move lower, it's going to have a direct impact on how the overall market performs, and we could lead to another stock market crash here in the very near term. And now also because of the severity of the issue we're going through right now and how much it is affecting banks and is expected to affect banks, the Fed actually did something different this year, and they did some additional tests to pretty much see how these banks would perform if different scenarios end up playing out in the economy. So the Feds tested a V-shaped recession and recovery, a slower U-shaped outlook, and a W-shaped scenario that would include a double dip recession. Now the Fed did not say that they are predicting any one of these to play out, but it did align with some other predictions that stated that unemployment could hit nearly 20%, which is extremely close to the levels that we saw during the Great Depression. So this is a big deal. Now if some of the worst case scenarios do end up playing out, the Fed predicts that the banks could rack up as much as $700 billion in loan losses. And if this does happen, it could push some banks close to their regulatory minimums for capital. In other words, it could put some banks on the brink of collapsing. And that is definitely not something we want to go through ever again. Remember, banks are a pillar of the economy, and if they fall, the whole economy is in big trouble. So from my perspective here, I do think that it was smart for the Fed to take some extra precautions and extra steps during these unprecedented times to make sure that some of the largest banks in the country are able to sustain themselves. Now again, it doesn't mean that these worst case scenarios will play out, but it's always good to understand what these banks will do if that does happen. Unfortunately though, no matter what scenario plays out, the outcome is not good for shareholders because dividends are going to be hurt, share buybacks are going to be suspended. So as an investor, do I think that this is a good opportunity here to buy the dip in these bank stocks? Well, personally guys, if you couldn't tell from my tone, I don't think that any of this news here is really bullish for this industry. In fact, it does concern me a little bit here because it tells me that because the Fed is going through all these other lengths to make sure that these banks are in good standing, that the economy is not recovering as quickly as we hoped. But what also concerns me is that the Fed has control on these banks and is now forcing them to suspend their buybacks, which in most cases a lot of these banks have already done voluntarily earlier this year. But they've also added restrictions here on their dividends depending on their earnings, so that's another big concern. Usually, yes, you would say dividends should be dependent on their earnings, but if we're suspecting that this is a short-term issue, maintaining a dividend for some of the larger players like JPM shouldn't really be a problem, but clearly this raises some concerns that this could be a bigger issue than we're expecting. So overall, I'm not happy with what I see here, and I will tell you this, that no, I am not buying the dip, and I have no plans to add any more bank stocks or buy new positions in bank stocks in the foreseeable future. Going into this year, I was very bullish on banks. At the beginning of this global issue, I was still pretty bullish, neutral bullish, more to the bullish side. But as things have unfolded and we've gotten into June now, almost July, things don't seem to be getting better at all, and I am turning more bearish on this industry. Also, remember back in May when Buffett sold out of some of his biggest banks? He almost closed out his position in Goldman Sachs, and he also started trimming his position in JP Morgan. Well, remember how people were saying, well, he just wants exposure to be below 10%, oh, he doesn't know what he's doing, he makes a lot of mistakes now, and all these other negative things about him. Well, I think that it's now clear that Buffett saw this coming from a mile away. He pretty much laid out this scenario and figured, you know what, I don't really want to hold some of these banks, or maybe a lot of these banks, through the next few years because we don't know what's going to happen. I'll tell you this, that in the next filing that Berkshire releases, I would not be surprised to see them close out some of their bank positions completely or significantly trim them down to levels that are much, much smaller. Buffett understands banks, in my opinion, better than most people do. There's been some of his largest holdings for the longest time. So if he's selling these stocks, there is some concern that he sees. And now we're finally starting to see what he possibly could have seen coming for the last couple of months. So I will say that there is some serious risk here with this industry. Now, I won't say that they're as risky as like airlines or cruise lines or those kind of stocks, but I will say that there is a significant amount of risk compared to, say, about a year ago or even 6 months ago when it came to banking stocks. This has changed my perspective on these stocks, and as I said, for the foreseeable future, no more plans to add any more of these stocks in my portfolio. Guys, as always, if you enjoyed this video, hit that like button down below. If you're interested in joining the VIP membership group, link description down below as well. Either way, thank you so much for watching. I hope you learned something from this video. But either way, don't forget to invest positively, and I'll see you in the next one. Peace.